Hi guys, so let's now take a look at our statement of comprehensive income, which is also known of course as the profit and loss account as well as the income statement. Let's take a look at what we've got in terms of the actual purpose of this actual account. So first up, it will set out revenue and expenses. So it will set out two different types of costs. Those costs will obviously be your direct costs through your cost of sales, but it will also include your indirect costs through your day-to-day operating costs. Okay, that will include things like utility bills, as well as paying rent, as well as paying staff salaries and so on. Okay, now, it will also allow comparison between different periods. So you can compare your profit levels to last year. That enables people to actually tell whether revenue is growing, whether your sales are actually growing, whether your profits are rising or whether they're falling, and so on. Okay, that can be very, very useful. Now, big public limited companies that are listed on the stock market need to release their actual profit statements every 3 months. Okay, so they need to report to the market every 3 months, and of course the market can then compare with the same 3-month period in the previous year, and you will then often hear these news stories about whether a business has done well, whether it's done badly, and the share prices are likely to respond to that news, of course. So it enables that calculation of net profits, and it also tells people how you're intending to use those profits, whether the money is all being distributed to shareholders via dividends, or whether it's all being retained and reinvested into the business, or alternatively, if the business is trying to balance both sort of angles there. Okay, so there's a number of key calculations that you must understand when it comes to this statement of comprehensive income, foremost of which, of course, number one, sales revenue minus cost of sales equals your gross profit. Number two, gross profit minus expenses equals your operating profit position, of course. Okay, so this operating profit is really about your high quality trading profit. So the fact that it is just derived from gross profit minus those additional indirect costs here means you get this final figure of operating profit. Now this is different from net profit, because net profit does include extraordinary items. Extraordinary items might be the sale of an unused asset, perhaps, which gives you more income, but artificially inflates the actual level of profits that you're getting. And after all, if you've sold that asset in one period, you will not be able to sell that asset in the next period. Okay, so as a direct consequence of that, operating profit and net profit are slightly different. Okay, and we can see this down here, that we've got gross profit, we've got the high quality operating profits, your day-to-day trading activities, and then you've got your net profit, which is your day-to-day trading activities plus any other income that the business has actually earned here through things like selling old assets. Okay, and then you've got your net profit position after tax, so how much money are you left with and what then happens to that net profit before finally you may have some retained profit which gets reinvested back into the business. Okay, now there are various adjustments that are made to the account, foremost of which is depreciation. Okay, the fact that assets depreciate over time, so vehicles, machinery, as well as to some extent it could also be about buildings or facilities that you've got that actually require maintenance, then there is going to be some depreciating effect on the actual assets themselves there. Okay, and this is due to firstly wear and tear, but also the time effect on those assets. So if you've got a set of computers that you've invested in, even if they're still functioning very, very well, of course technology will continue to improve, and as technology improves, the actual value of those computers themselves, even if they're still in a box, will actually come down in value. So businesses need to actually deduct those indirect expenses, those indirect costs of depreciation, and this is really about just really reflecting the overall costs that a business is actually incurring in its day-to-day operations. Okay, so that's really, really important, and businesses can actually have a choice as to what rates they choose to depreciate those assets, and this is something that we will look at in a great deal of information on later on. Okay, so depreciation is an expense. A high rate of depreciation will reduce net and operating profit, but if you choose to keep those assets for longer and depreciate the value at a low rate of depreciation, it will increase net and operating profit. Okay, so businesses do have a choice, and they can even use this to carry out a process known as window dressing, where they can artificially inflate the size of their profits by depreciating perhaps at a slower rate if they want their business to look particularly good. Okay, so let's have a look at prepayments and accruals. So prepayments, pretty straightforward, paying in advance before you actually receive the items. Okay, that's a prepayment, obviously. When you incur an expense which isn't yet paid, of course, we've got an accrual. An accrual there. Okay, so again, nice and straightforward. Something that we'll see more of as we work through these lessons. Okay, and then overall, the actual interpretation, analysis, and evaluation of these accounts. This is something that's going to be very important to you, for you to be able to do. So it needs comparison. It's no good just taking one and then actually considering where the business is. You need to conduct a comparison, and you can compare with previous periods. So how has the business actually performed over the last few years? How does it actually perform against competitors as well? What level of profit are competitors making, and how does that compare with this given business? And you can also think about what sort of impact the external influences might be having. So when it comes to something like inflation, is inflation artificially increasing the actual size of that revenue rather than it actually reflecting purely an increase in sales? Okay, so yes, you do need to factor in these different areas there, okay, to enable a full analysis to actually be undertaken. Great stuff, guys. Thanks for listening. See you next time.